Hello and welcome. This is BloombergQuint Stocks to Watch. I am Agam Vakil. This is where we take you through three stocks or sectors which are in focus in the news and we take them up with our experts. Well, today we are talking about Wipro, State Bank of India, and the real estate sector. And we're going to take them up with Rusmik Oza. He's the head of fundamental research at Kotak Securities. But before I go across to Rusmik, let's take up the first stock that we have on our radar, and that's Wipro. Now, we do have Wipro's earnings, which came last evening. There were hits and misses, but on the whole, when it comes to just the revenues, they declined by around 5% in rupee terms, and that was on expected lines. But what we saw was margins expanded by, in fact, about 110 basis points sequentially. This is after an expectation of nearly flattish movement on margins. Why did that happen? Well, lower employee costs, rupee depreciation, and overall improvement in operations, according to the CFO. But let's get in Rusmik into the conversation. Rusmik, good morning, and thanks for joining in. How do you see Wipro? Because there was a little bit of a positive surprise when it comes to profitability.
Good morning, Agam. We have upgraded the stock. We earlier had a reduced rating. Now we upgraded to add rating with a target price of 265. The results were quite encouraging in the backdrop of whatever we have seen in terms of lockdown and globally COVID impact. Though the revenues are down 5-6%, I think so. The EBIT and the net profit EPS has gone up by almost around close to 6% now. So we're seeing quite improvement in some of the segments, though BFSI, which is 31% of the company's revenue, is still not seeing much traction. But the management and the company are expecting recovery in the second half. Few things which are in favor of the company, which have turned us positive. One is valuations. The stock trades very cheap, so our target price of 265 is based on just 14 times FY22 June 22 estimates. Second is attrition levels have gone down from last year more than 15%. Now it's come down to almost less than 11%. Revenue and earnings should grow in single digit. So though the parameters don't match up with the Wipro, TCS and Infosys, but nonetheless the growth is going to be there in the company going forward, and that makes us a little positive on the stock. Another positive point is the new CEO has got extensive experience with earlier Capgemini, and he's talked about driving a strong growth going forward. So these are some of the reasons why we feel Wipro could be a stock I should look at, and you could see a decent upside coming from the stock going forward.
Let's move on and talk about State Bank of India. And what we understand is that it is looking to raise about 20,000 crores by a follow-on offer, private placement, including a QIP. Of course, there would be a lot more methods that the bank will use. In the latest, of course, we also have Yes Bank, where its follow-on offer will go on the floor today, which will open for subscription today. But Rusmik, let's stick with State Bank of India right now. And I want to talk about that because we have seen some weakness in the banking sector of late, given the kind of correction that we've seen over the past 2-3 days. What's going on, and how do you rate State Bank of India at this point?
I think we were quite optimistic and positive in SBI, though the entire environment is not very conducive because of the extended moratorium, and there are some rumors that the moratorium might get extended, but it doesn't have any sound. We don't expect that probably maybe happening too soon. In case of SBI, I think if you look at the capital adequacy ratio of the bank, it's around Tier 1 capital is around 11%, and the overall capital adequacy ratio is 13%. It's quite adequate, but nonetheless, as compared to the private sector banks, it is a little on the lower side. And last week only, the RBI governor also has stressed that banks should actually try and strengthen the balance sheet by raising capital to meet with any unforeseen NPAs that could come up because of this moratorium, as and when the moratorium gets over. So it is a good sign that banks, if they can actually strengthen the balance sheet, it sends the right signal to the investment community. In case of SBI, particularly because it is one of the strongest bank in the PSU space, I think it makes sense for it to be in a very strong a strong strength in terms of ability to raise capital and then also lend when activity improves. As of now, I think Q1 results will be quite impressive from SBI, though it is little early days to predict the numbers of banks on a quarterly basis. But nonetheless, we're expecting around 7% loan growth. I think net interest income should go up in double digit around 10-11%, and there'll be decent treasury gains, mainly because of the recent stake sale in SBI Life Insurance, plus the bond yields have gone down. These two factors could give a very sharp jump in the treasury income, which could give you a very healthy earnings growth. So, for example, as compared to last year, 2,300 crore profit in Q1, we're expecting profits to be around 6,700 crore. If this print comes in, it will be a very good number to watch out for from SBI, because at a time when the manufacturing sector will be reporting very disastrous results, this could be quite encouraging. So overall, and the fact that if you value the subsidiaries of SBI in a target price of around 340, 140 rupees is attributed towards the valuation of subsidiary. That means we're just valuing the main bank at 200 rupees when the book value is estimated to be around 220 this year. So we are valuing the bank at less than 1 time price to book. So which is like very cheap and attractive as compared to its historic valuation. There's a lot of value, deep value in SBI. We are quite positive on the stock.
Okay, all right, and we move on to the final, not stock, but a sector, because we've had earnings from some of these realty companies like Oberoi Realty, Sobha in general, and well, trends have been mixed, and all the companies are suggesting that there will be a gradual improvement, but for now, of course, as we on expected lines, the numbers have been extremely weak for the quarter gone by. That's the first quarter of FY21. If you consider the year-to-date movement of the Nifty Realty Index, that's down 33%. Of course, you do have the likes of Prestige Estates and Mahindra Lifespace Developers, Suntec Realty, really underperforming. But even some of their relatively steadier names, like something like a DLF or Sobha, have also underperformed the index. What has not underperformed that much is perhaps something like an Indiabulls Real Estate and Godrej Properties. Those are the two standout names because the depreciation on a year-to-date basis has not been as severe as compared to many of the other companies. So Rusmik, just come in and weigh on the entire sector. Perhaps if you could talk to us about the stocks that you like, or whether or not you would completely avoid getting into a sector at this point in time.
At this juncture, when the markets have run up, so most of the sector and stocks have run up quite healthily. We're quite positive on the real estate sector. Maybe not from a very short-term perspective, but from a long-term perspective, I think the sector offers quite attractive, healthy returns going forward. Just to give you an example, the top 8 companies that we cover in our universe, we have a target price upside of almost 40% plus on an average basis, if we exclude Godrej Properties. So in our universe, we are negative only in Godrej Properties because of the rich valuations. Otherwise, most of the stocks on an average are offering almost 40-50% upside from current levels. Because in case of real estate, what happens is, we value them on NAV basis, and the NAV captures all the land bank plus the future cash flows that are likely to come in. It's like what we do DCF in case of a normal manufacturing or any other company. We use the NAV basis over here, and that offers quite healthy upside. I think obviously Q1, Q2 maybe will be a little poor because of unsold inventories, and a lot of the builders will be pressurized to sell properties at lesser price. That's, I think, so nuance of the sector which will play out in the next 1, 2, 3 quarters. And there's a lot of pressure on some of the large real estate players also are a play on rental yield. So that's one area to watch out for, because a lot of players had to offer some waiver on rental during the lockdown period, and some of them also have hotels as a portfolio. There also is going to be there will be a big knock. So this year earnings will show a very sharp deceleration. For example, in Q1 itself, we're expecting earnings of the basket of 8 companies to go down by 90%. The revenues could be down 40-50%. But if you looking at a little long-term view, I think so. Based on NAV, there is decent upside in the sector, and one stock really stands out in this space is Embassy REIT. That company, offers a dividend yield of almost around stock offers a dividend yield of almost around 8%. So it's a classic combination of very high dividend yield, and one can also capture the upside the sector offers in the long term. So this embassy rate could be on extremely bullish, and maybe extremely negative on Godrej Properties because of the rich valuation in this space.
All right. Well, Rusmik Oza, on that note, we leave it at that. Thank you so much for joining us and taking us through those stocks and sectors. We'll be watching out for some of these names that we've spoken about today. And on that note, it's a wrap on this segment, but there's lots more lined up. Stay tuned to Bloomberg Quint and keep bringing you more.